Today, we're diving deep into the financials and operations of Optex Systems Holdings, Inc. That's ticker OPXS. They're a small-cap aerospace and defense company focused on optical sighting systems. This follows on from our recent look at Sifco Industries, SIF.
Right, and with OPXS, we've got this classic tension, haven't we? You've got truly exceptional recent financial performance, profits looking good, big contract wins, but, and it's a big but, you also have this sustained, really high-volume selling by insiders and these big 10% owners. So the core question is, how do you weigh those two things?
Exactly. And my position is, fundamentally, the strength you see in the numbers, the growth, the profitability, that really pristine balance sheet, that confirms the stock's value. I see the insiders selling largely as, well, predictable profit-taking after a great run. Secondary events, really.
See, I come at it from a totally different angle. While those ratios reported are, yes, impressive on paper, the actions of management, the board, the big shareholders, they tell a much more cautious story, I think. For me, that sheer volume and breadth of selling signals a critical lack of confidence from the people who know the business best. And while that signal tends to override the positive metrics we're seeing in the reports, suggesting maybe the operational peak has already passed.
Okay, let me lay out why I see the fundamentals as so compelling here. OPXS presents a really strong fundamental profile, especially, for a small cap in this sector. This looks like a company hitting its operational stride and, crucially, turning that into real shareholder value. Let's just look at the growth path. Sales year over year, trailing 12 months, up 21.00%, okay? And that's almost perfectly matched by a 20.18% jump in earnings per share. So this isn't just revenue growth for growth's sake. It's profitable, it's capital efficient scaling. And if you look back over 3 years, sales growth averaged 23.10%. That's consistency. That's a powerful trend. And the profitability metrics, they're fantastic. A profit margin of 13.1% shows really excellent cost control, and that feeds directly into powerful returns on capital. Their return on assets, ROA, is 19.01%, and maybe most important for shareholders, the return on equity, ROE, is 25.14%. Just think about that for a second. For every dollar of shareholder equity, they're generating 25 cents in profit. That's the definition of a machine efficiently deploying capital.
Those figures are stellar, I absolutely agree. On paper, they make a very strong case, no doubt. But the foundation of my skepticism really rests on who is making money from that performance right now, and critically, who is deciding to sell their stake. While the reported ratios look, really clean, the actual actions of the people running the show, management, directors, major funds, they paint a far more cautious, almost skeptical picture. We absolutely have to talk about the insider transaction metric. It's overwhelmingly negative, sitting at minus 15.87%. And just to clarify what that number means, this is the net change in holdings for insiders and those as 10% owners. This isn't, 15% of one executive's personal shares. This represents a systematic reduction, effectively a net liquidation of a really substantial chunk of the overall shares held by those closest to the company.
We're seeing significant sales by key 10% owners, like Top Line Capital Partners, making big moves end of June 2025. And crucially, this selling is broad. It's the CEO, Danny Robert Schoening, the CFO, Karen Lee Hawkins, and multiple directors, Malhotra Rimi, Dayton Judd, Dale Lehman. They are all actively turning their shares into cash. Right now, the very people with the best, the most non-public information are aggressively selling. That raises some pretty severe questions for me about the future durability of that financial strength everyone's looking at, regardless of how good the last quarterly report was.
Okay, I acknowledge the volume of those sales is significant, yes. But my argument is that the company's operational momentum and its structural stability fundamentally outweigh what could just be a liquidity event for those individuals. Let's focus on what's actually driving the revenue here. OPXS is deeply embedded in these long-cycle U.S. defense platforms. Think Abrams tanks, Bradley fighting vehicles, Stryker vehicles. This isn't like selling widgets. This is specialized, highly critical defense manufacturing. And this operational success is ongoing. It validates the underlying value. Look at the recent contract flow. There was an award up to $10.2 million for optical sighting systems announced just in July 2025. That followed pretty quickly on a $5.7 million order for laser filter units back in April 2025. These are substantial sums relative to their market cap, which is only about $87 million. The market has, I think, quite rightly, rewarded this execution. You see it in the 3-year stock performance, a staggering 417.62%. So when we consider these consistent contract awards, the specialized nature of their product, the valuation metrics you mentioned, a PE of 16.98, EV/EBITDA of 12.26, they don't scream speculative bubble to me. They suggest a company that's capitalizing on real, repeatable success within its mandated defense niche.
That's a compelling narrative. Definitely. But I think you might be focusing too much on the event, the contract win, rather than the reaction to it, which is the selling. Have you really considered the timing here? Why is this, mass exodus by principals happening right after these impressive contract announcements and following such a dramatic run-up in the stock? The price has shot up 106.54% just in the last 6 months alone. Management is systematically selling into that strength.
Well, it's logical to take profits after such a run.
Perhaps, but the timing is just too convenient. If the insiders truly believe these contracts heralded some multi-year sustainable acceleration in value creation, wouldn't they hold on or maybe even buy more? Instead, it looks very much like they view these contract announcements as premium exit opportunities. Look at the prices they sold at. Dayton Judd sold shares between $8.95 and $9.45 in June 2025. Topline Capital Partners, they sold right near the recent peak between $11.07 and $11.68, right at the end of Q2. So, the collective action, that negative 15.87% net transaction figure, it's a really strong indicator, I think, that the very individuals who engineered this recent success believe the current stock price might be running ahead of its sustainable intrinsic value. They aren't selling just because they need pocket money. They seem to be selling because they anticipate the peak of this specific cycle might have been reached or is at least clearly in sight.
I see why you'd interpret it that way, viewing the sales as a signal of, cyclical peaking. But I really believe that interpretation overlooks the robust structural defenses and, frankly, the financial engineering the company has put in place. This is precisely where the balance sheet becomes the ultimate mitigating factor. The balance sheet provides a massive buffer against any anticipated operational hiccups, whether that's a shift in a government program or just a short delay in procurement. Their liquidity is, it's pristine. The current ratio is 5.14. That means they can cover their short-term liabilities more than 5 times over. Their quick ratio, which excludes inventory, is 2.05. So they can cover liabilities more than twice over without selling a single thing. And on top of that, leverage is negligible. Debt-equity ratio is just 0.09. This kind of exceptional financial health is genuinely rare for a small defense contractor. This level of liquidity, this minimal debt, it really mitigates the risk you're associating with those insider sales. Okay, selling shares generates cash for the insider, sure, but it does absolutely nothing to undermine the company's own financial stability. The firm itself is still holding 70 cents in cash per share. It's fundamentally sound, highly capitalized, and ready for future growth, regardless of what Topline Capital decides to do with its investment strategy right now.
I absolutely agree on the health of the balance sheet numbers themselves. They are strong. But let me re-emphasize, confidence is currency in the investment world, especially for a company like this that relies almost entirely on government trust and, let's face it, unpredictable procurement cycles for its very existence. High liquidity, yes, it provides an excellent cushion against, say, bankruptcy. But it cannot, by itself, solve a confidence drain. When sophisticated 10% owners like Topline Capital Partners who, remember, still hold significant blocks and presumably have detailed knowledge of this sector, when they are selling tens of thousands of shares at those high prices you mentioned, that sends a powerful, unambiguous signal to the market.
They are either suggesting they're far better places to put their capital, or, more worryingly, they anticipate some kind of material softening in the business that isn't yet visible in the backward-looking financial reports we're discussing today. Think about it. If the forward outlook were truly as sustainable as those historical numbers suggest, and that impressive 25.14% ROE was genuinely expected to continue indefinitely, Why would a sophisticated capital fund actively reduce its position now? They're implying, through their actions, that the risk-reward calculation has shifted negatively. The high liquidity you rightly praise provides management with financial flexibility, yes, but it also provides a very comfortable, very efficient exit ramp for the insiders who seem to be taking it.
That's a fair critique regarding the procurement dependence, I'll grant you that. But let's just circle back to the core function of the business itself, which I argue does provide a degree of predictable revenue visibility. The company's specific work manufacturing these advanced optical sighting systems, these laser-protected periscopes, it's deeply integrated into those specific key U.S. defense platforms. This isn't a commodity product they're selling. It's a highly specialized defense niche. And this structural value seems reinforced by the fact that the Optex Systems Richardson segment generates the maximum revenue. This suggests, specialization and a dependency that the U.S. government actually relies on. And this structural value argument is, I think, supported by the growing order backlog mentioned in their news releases, and also by the high institutional ownership, 35.16%.
That implies that large, sophisticated investment houses still see long-term structural value in the defense mandate, perhaps looking past this temporary insider liquidation phase. These institutions, they aren't rushing for the exits. They seem to be holding their positions because they believe in the longer-term cycle of defense procurement.
That's an interesting point about institutional holders, though I might frame the dependence aspect differently. That very dependence on government contracts you highlight, that to me is the core business model risk. While it provides visibility if programs continue unchanged, it also creates massive concentration risk and, frankly, binary outcomes. One key program decision, even if it's years down the road, could completely redefine this firm's valuation overnight. And we lack true visibility into that concentration risk, don't we? We don't have detailed revenue by segment data beyond knowing Richardson is the main driver. And importantly, we have zero analyst ratings or forecasts to really back up the forward-looking story. We're relying entirely on the company's own internal reporting and press releases for any visibility into that backlog you mentioned. What we do have, though, is the concrete, indisputable action of the people running the business. The sheer volume of executive selling, including the CEO selling, 14,033 shares, and then another 5,967 shares in early June 2025, that suggests a personal, undeniable view from the top that the current stock price is significantly ahead of its sustainable intrinsic value. It seems insiders are prioritizing future risk over the current reported success, and their actions strongly suggest they see too much future risk baked in for the current price tag of around $12.63. They are quite literally voting with their feet.
We can certainly agree that the dual nature of government-dependent revenue introduces a unique risk profile. It definitely requires careful management and ongoing evaluation. However, my conviction remains rooted in the objective empirical evidence of superior financial management that OPXS has clearly demonstrated. They exhibit not just good, but really superior metrics, high margins, that pristine liquidity ensuring operational continuity, and verified rapid sales growth, 21.00% TTM. This is coupled with a substantial, verifiable series of contract wins, validating their operational strength in a vital defense niche. So for me, this presents a case where the fundamentals strongly support the current valuation. And while the insider activity is, yes, significant, I still maintain it should be contextualized primarily as profit-taking after a truly historic run-up, not as some fundamental rejection of the underlying business model itself.
And while I genuinely appreciate the thoroughness of that fundamental analysis, the sophisticated investor simply cannot afford to ignore the clear, potent signal coming from that insider activity. This isn't just isolated profit-taking. It looks like a systemic reduction of risk across the entire leadership structure and major ownership base. The persistent widespread sales by key executives and major owners serve as a powerful cautionary indicator. It suggests, at the very least, limited future upside from this point, or potentially flags unforeseen risks ahead, despite the currently positive financial picture. This inherent conflict between undeniable reported strength on one hand and a critical lack of owner conviction expressed through selling on the other, it really illuminates the complexity of analyzing small, high-growth, government-dependent companies like OPXS.